Welcome to an exercise that deals with about three different things. We're going to continue our discussion of fixed assets, and we're going to discuss asset acquisition and how we record costs. We're going to record some depreciation, and then finally we are going to dispose of the asset after some time. So we're gonna with a very limited scenario, we're going to trace an asset, looks like a machine, all the way from asset acquisition all the way through to disposal or disposition, sale of the asset, however you want to put it. Okay, so when we see disposal here, that generally means that we are selling it for cash. Sounds like we're throwing it away, right? But we're not. That would be retirement. Okay, so let's look at our scenario here. It says on January the 2nd, Verdi acquired a machine for $75,000. In addition to the purchase price, they spent $2,100 on shipping and installation, and $2,600 to calibrate the machine prior to use. The company estimates that the machine has a useful life of 5 years and a residual value of $11,000. So residual value is often called salvage value as well. So looks like we don't have any numbers that we're not going to use. That's very, very important because we need to be able to apply the rule of purchase price, which is this $75,000 right here. And then we also need to include any one-time costs that are necessary to get the asset, whatever the asset is, ready for its intended use. So shipping, we're only going to ship the machine one time, or it's only going to be shipped to us one time. So that's it. Installation, we're only going to install it one time. So this $2,100 is going to count. $2,600 to calibrate the machine prior to use. This is called testing, and this is also something that at least the first time that we do it would be added to the asset's cost. So let's just come right over here and add these figures up, because that's the first thing that we have to do down here. 2,100 plus, let's see, 2,600. Going to give us 79.7. Move this down a little bit. Okay, so let's see here now. There's no indication that we did not pay cash for this asset. So what we would do is we would merely have a debit to machine and a credit to cash. Now in reality, we might have done these items not on the same day, but close to the same day. And so we could have up to 3 different entries for this. And at the end of it, our asset value would still be the same, 79.7. But this is a lot better. This is a little bit easier. 79,700 for both our debit and credit. So our historical cost for the machine is $79,700. Okay. It says here for B, calculate annual depreciation expense using the straight line depreciation method and prepare a journal entry to record depreciation expense for 2016. Okay. Well, because we're going to be using straight line depreciation, this $11,000 right here actually matters. So let's move this up here. We're going to have to establish our depreciable base, and so we're going to subtract from this the $11,000 salvage value. Okay, so our depreciable base is 68.7, and then we are also going to be using this for 5 years. So we can divide by 5, and we can get our annual depreciation amount. Now notice that the machine was purchased at the very beginning of the year. So with the exception of one day, January the 1st, we basically have a full year here. So that's what we're going to do. Now, if we know about the historical cost principle, we know that this machine must be left on the balance sheet at $79,700. So how do we get to the net value? Well, the first thing what we're going to do is we're going to utilize the income statement account depreciation expense. And of course, anytime we see the word expense, that is a giveaway that we are dealing with an income statement item, and expenses go up on the left with a debit. And we're also going to take that $13,740 and put it right here. And we're going to adjust the value artificially. Remember, again, $79,700, we can't touch this on the balance sheet. It has to show $79,700. We also have to give an indicator of the net book value of our assets. So we're going to use this account called accumulated depreciation. Okay, for $13,740. So this is what we call a contra asset account. It is essentially an adjustment account for our fixed assets. And so what we would say at this point is, after recording this depreciation, that we have a historical cost of $79,700. And we would have a net book value for this asset of $65,960. Ignore the negative sign there. Ignore that. Okay. So now that we have the annual depreciation established as $13,740, we can move on to requirement C. And it says on December the 31st of 2019, Verdi sold the machine to another company for $14,000. Prepare the necessary journal entry to record the sale. All right. So we know that they've given us 2 of the 4 accounts that we're going to need. They've given us cash and accumulated depreciation. And they've even told us how much cash it's going to be. So we might as well write that down, $14,000. Notice that when we take depreciation expense, our accumulated depreciation has a normal credit balance. So we now have to get this accumulated depreciation off the balance sheet. You don't have to do anything with depreciation expense because the income statement is going to reset to 0 on the very next day anyway, because income statement accounts are temporary accounts. However, we do need to figure out how many years we have had this asset, and we've had it for 2016, 2017, 2018, and 2019. So that means that over on the balance sheet, we have this $13,740 times 4. And that has to be removed from the balance sheet with a debit. We can't leave it on there after we dispose of the asset. All right? We also have to get rid of the machine itself, and that has to come off with a credit. And I'm going to actually do this down here, and the reason is because just in case you were working on something very close to this, I have a feeling they would want this down here. Maybe not. Maybe they won't care. So now we have to say, okay, what do we balance here? And we can take one look at it and tell that we don't. So let's just see here what we have. $79,700 minus $14,000 minus 54,960 is 10,740. And so we have a debit for $10,740, and this is a loss. So losses have a normal debit balance, loss on disposal machine. Okay, for the $10,740. Now that's all we actually have to do here. Losses have a normal debit balance, so they have the same normal balance as an expense. And gains, if we had dealt with a gain, are treated like a revenue. They have a normal credit balance. So here's the other thing. We need to apply a rule here, and we would say that we have a loss if the amount of cash received is lower than the current book value. Now we haven't calculated that, but actually we have, and I'll show you what I mean here in just a moment. And we would have a gain if the amount of cash exceeds the current book value. So how do we know what the current book value is? Well, we take the 79.7 and we subtract from it all of the accumulated depreciation. And so our book value was 24,740. We compare the book value to the amount of cash received. The cash is less, so that tells us that we're going to have a loss. Now we already know that because it's right there. We can also do this a different way and subtract the cash proceeds out, and it's going to give us the same $10,740 here. So we could have done this as a plug. But if we, that would do using as a plug would get this 10,740 here. But if we don't know the rule that we have to subtract the accumulated depreciation taken from the historical cost of the asset, we won't be able to compare book value to the cash proceeds, and we might label this a gain incorrectly, right? Especially if we don't know that gains have a normal credit balance and losses have a normal debit balance. If we know all that, well, we could have saved some time. We could have stopped talking a couple of minutes ago. Anyway, that's it for this video. I hope you learned something.